Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we're going to talk with Wall Street legend and co-founder of Chaikin Analytics, Marc Chaikin.
And today, Corey and I will talk about banks, the Fed, and something you should actually do, research you should do on your own bank.
And remember, if you want to send us a note, send it to feedback@investorhour.com and tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. Another day, another bank in trouble. And this time it's Deutsche Bank, but I don't see any news, on the bank itself. It's just the stock is tumbling, the credit default swaps are soaring, and there's just like a rather frenzied market in the put options. Everybody wants to bet on Deutsche Bank again for about the 50 millionth time in 10 years. It's just, it's been ongoing for years, and now it's just worse, I guess.
Are the banks becoming meme stocks at this point, or what's
reverse
going on?
Meme? Yeah, it's reverse meme.
Yeah, more panicky moments continuing. It's where is this headed? We don't know, but it's surely a consequence of everything that we've talked about for a long time, and the Fed rate hiking, and we just got through another meeting and Jerome Powell jam session, and by that I mean press conference, and
jam session.
And here we are again. It didn't do much, I think, to calm any nerves. I don't think they raised rates again. And seemed to indicate that they'd be stopping at some point here in the next couple of months. But, who knows what happens between now and then. So things have changed before.
Right. And, the Fed wasn't the only one. It was like, it was the Fed, and I think Bank of the Philippines, Swiss National Bank. I should have written these down, shouldn't I? Bank of England, Norges Bank, Norway. So, everybody's continuing. It's like, the inflation worry is actually sort of bigger, apparently, in their minds than the banking. They're not worried about the banks as much as they're worried about inflation. That's sort of how I take it anyway. I don't know.
Yeah. I mean, by hiking rates, you would think that's what that means. At the same time, though, at least the Fed is adding back to its balance sheet by papering over what happened, the fears of more bank runs happening after the Silicon Valley failure. So you kind of got two big levers going different directions there. So I think they're just doing what they need to do to like stave off instant panic in the short term, and then hope that the inflation numbers keep going down the rest of the year, and then they'll be able to naturally kind of just stop raising rates. But who knows where the economy will be at that point? Maybe they'll be cutting rates at that point. So, and we'll be talking about whether inflation is going to go back up again uncontrolled. So it's a kind of from a monetary policy point of view, it's a bit of a mess, I would say. And this is the problem when you're trying to manipulate all these different twists and turns in the $26 trillion economy from the U.S.
And I have to change the subject slightly here, because I just wanted to get in the fact that we found a bank that actually, according to the shareholder letter, they didn't do what everybody else seems to have done, which is buy treasury securities, especially at just pitifully low yields, just begging for just begging for losses, really, basically. And the bank was M&T Bank. And he's got this, they wrote this shareholder letter in which they pointed out that basically, other banks did this. We chose not to do it because we didn't think we were being compensated for the risk. And guess what happened? And they sort of laid out the numbers.
Mm-hmm.
He said, we would have made X, forget about the specific numbers, but he said, basically, we would have made, a few bucks worth of interest, but we would have lost hundreds of millions of dollars to, bond losses caused by, higher rates due to Fed raising rates on fears of inflation. In other words, we avoided this, so why couldn't other people avoid it too? And I think other people were just, they were Chuck Prince at Citigroup. As long as the music plays, you got to dance or something. But M&T Bank says we didn't do this, or at least not as much. I mean, everybody holds some securities, but yeah.
That's interesting and good to hear. It's similar to, I know I got a piece of feedback in one of the digests this week from somebody, one of our subscribers who's been in regional banking for 40 years. And he essentially said the same thing. Most of the banks are smarter than what Silicon Valley Bank did, which I believe. Otherwise, we'd have, there'd probably be a lot more of those stories happening right now. Now, who's to say what happens in the future? And like we said, if a bank run happens, a bank run happens, to whoever it is. But that's that. I'm glad somebody, a good management team, put that out, because that's what was this puzzling to me. I was like, why would you, if you knew the Fed was going to raise rates that much, and you had a member of your CEO was on the Fed board in San Francisco, why would you buy these long-term things at 1%? It didn't. I don't know. Like I said, I'm not a banker, but that doesn't make sense to me. And so, good. I'm glad maybe I have some friends at M&T now. That would be, yeah.
And it's just one of the beauties of Twitter. I was not rooting through bank shareholder letters. I was just sort of hanging out, looking to see what was what, and if there was anything crazy that wasn't necessarily in the headlines, and to get the takes of various people that I follow, hedge fund managers and people. And up pops this M&T letter. So the thing that
just one more thing on that, if I guess.
Yeah.
So maybe to the point of the Fed seems to be still more focused on inflation than the if they are more focused on inflation than worrying about bank failures. Maybe that's why. Maybe they're like, okay, if the weak links are gonna emerge now, like that's okay in a sense, because Powell seemed really pissed off, I would say, at when he got questions about Silicon Valley Bank last week. Just like he was annoyed that you guys screwed up our whole plan here, and that's the sense I got from a couple of his answers. And so I think maybe they're hoping or seeing that more of those aren't going to happen in the short term, at least.
Right. And yet last August, what did he say in Jackson Hole? He used the word pain twice. There will be significant pain on, U.S. consumers and businesses and things. And guess what? It's just like you and I have been saying, they're going to hike until they break something. Well, they broke something, right? I mean,
and then they still hiked.
It makes sense. Yeah, they still hiked anyway. Yeah. And it makes sense that, of course, what breaks is going to be like the most poorly managed thing. That's not a surprise. But still, my concerns remain. Everybody who's holding treasuries took a hit. There's got to be more troubles related to that on the way, because it's collateral, right? So the value of collateral is down 20, 30%. And, so a bunch of banks will probably like raise equity or something, right? I mean, that'll be maybe some of the fallout. I'm not saying it's going to be the, Great Depression, 300 banks going under or something, but I do think there has to be more problems just for that one fact alone. The Treasury's got murdered so bad last year.
Yeah, I would think so. The thing I keep thinking about now is beyond the banks, what happens next with credit and corporations and businesses, and what that looks like this year or the rest of this year with earnings,
right.
and
yeah. So two shoes to drop. Car loans, people went nuts buying cars, and now the delinquencies are up on car loans. And the other one, of course, is commercial real estate. It's like 92 billion maturing this year. In office alone, that's just office. And office has gotten obliterated, right? I mean, work from home was happening anyway, and then pandemic came along, and woof, work from home went into like overdrive, and people are still working from home. Office buildings are empty. They're defaulting. PIMCO's defaulting, and Brookfield is defaulting. These are not poorly financed people. They're not idiots. They've been around the block, and they're defaulting.
Yeah, and then you mentioned car loans, and then you could look at those companies that are involved in that business. But then also, I've been thinking in the same vein of consumer debt, levels that have been rising and rising as more people use credit cards to pay for stuff that they're using, tomorrow.
Right. And all those rates are variable. And here we are at the fastest hiking cycle since 1980.
Right. Yeah. I spent a little time this week trying to find the worst of the buy now, pay later companies that I could find to maybe take some fun on a buying some puts against them. Because I don't think that was a part of the beginning of the bubble, of this last bubble. Buy now, pay later. So inevitably, I think it will be part of the burst too, when the credit crunch really catches up with the economy, which I don't think has happened yet. You would think so. That's one. That's where my mind's at. Like what's gonna implode here in 6 months, and maybe balance, part of my portfolio that way.
Yeah, I was shocked. I am still shocked. It's still ongoing. You can buy, I'll buy like a book for $20 or some inexpensive item under $100 or under $50 or something on Amazon or someplace. And then this little thing will come up and say, or you can make, 4 monthly payments of so-and-so. I'm like, it's $40. Right. It's just like, what are you telling me here?
Yeah.
It's sort of like, the world is just giving everybody a credit card basically at that point. Whether you got one or not, hey, you got one. It's called us. We're your credit card.
And eventually, what happens when you can't
see all that working out?
When they can't make the last 2 payments on that book, and that adds up over however many customers. I mean, these are smaller items, but the point is, like, that's sort of indicative of this whole pandemic bubble, I think.
If you got to make a choice, you lose your job, you're out of money, you got to pay rent, or you got to make the last 2 payments on some piece of crap you bought on the internet or something,
right.
Some little appliance or pair of jeans or something. Yeah. What are you going to do? So, yeah. So it will surprise us both then. In conclusion, it will surprise us both then if we do not see more credit problems. Neither one of us seems to believe this is the end of it.
Correct. I don't know when exactly they will happen or exactly what form it will take, but yes.
Yeah, timing is not our thing here, folks. We're not saying it happens next week, or Tuesday afternoon at 3 p.m. or anything, but they have to be out there for the reasons that we've laid out, right?
Yeah, I would say if you're not accounting for just credit risk, generally speaking, that would be a mistake at this point, heading into the second half of this year.
And somebody asked me on a conference call yesterday, or a day or two ago, whenever, do you still have your money in the bank? What about your bank? Are you worried about your bank, Dan? And of course, the only answer that I could give was, my bank is on the too big to fail list. So when they start printing up the money, if things get really bad, my bank is going to be one of the first to get it, and it'll stay open. And, there's two lists. There's like the big sort of list with Goldman and JP Morgan Chase and Bank of America and all those. But then there's like what they call the domestic systemically important financial institutions, SIFIs. And my bank is on that list. And it's got everything. It's got like Capital One and Ally Bank and American Express and all kinds of other stuff on it. Regions Financial, Truist, a bunch of, just domestic banking operations. But
and actually,
you might want to Google that and see if your bank's on.
Well, yeah, that's maybe step one. And then Powell actually at the press conference said, somebody asked him about, so why did you guys, invoke the systemic risk exception for Silicon Valley Bank? And he said, well, it wasn't really on them specifically. It was for the risk of contagion everywhere else. And so if they're going to do that, then, that kind of tells you, even if a bank is not on one of these whatever exempt lists, that they're probably going to be inclined to step in.
If they're trying to make us feel confident, they're telegraphing all the wrong stuff. They're saying there was contagion risk. We had to do it.
Yeah, that's what they said. I mean, because that bank was not on they weren't subject to, Silicon Valley wasn't subject to these Fed stress tests, which, so it's
stuff to think about and things to do about it. Google your bank. Google the list of systemically important financial institutions and see if your bank is on it. Maybe like now. So, all right. Unless you have anything else, I think we should move on and talk to Marc Chaikin.
Yeah, no, I'm good. Let's clear the deck for Marc. I'm excited to hear from him.
Yeah, I love Marc. His system is on like every Bloomberg terminal in the world. He's been there, done that, had George Soros for a client and all this stuff. And I just love the guy to death anyway. So without further ado, let's do it right now. Let's talk with Marc Chaikin. If you're holding out hope for a bull market, then please pay close attention. According to legendary investor Marc Chaikin, who Jim Cramer famously said he'd never bet against, you need to prepare for the next wave of volatility to hit U.S. stocks. Marc's prediction is based on an indicator that has only triggered a handful of times in the last 72 years, with a 100% success rate for predicting where stocks will go next. Now, the man who's just spotted it is sounding the alarm. During Marc's 50-year career, he's worked alongside some of the biggest investors in history, including Paul Tudor Jones and Michael Steinhardt. In fact, Marc invented one of Wall Street's most popular indicators for picking stocks, still used by hedge funds, banks, and brokerage sites, and today found in every Bloomberg terminal on the planet. Now, Marc's inviting you to join him as he explains exactly what the next wave of volatility will look like and where it will send stocks in the coming weeks. He's even sharing one of his favorite ideas free for those who tune in. He says this idea could create bigger gains than anything he's used his power gauge system for until now, by turning the coming market volatility to your advantage. And you don't have to wait until March 28th to get started. For a sneak peek of Mark's big reveal, go to ChaikinEvent23.com. That's ChaiKin Event23.com. Mark, welcome back to the show. Nice of you to be here again.
Dan, it's good to be with you.
So I just want to jump in here because our listeners are familiar with you. So if they want to find out about you, they can go back in time and listen to some more of your thoughts in past podcasts. But we need to jump in head first here because we're in the middle of this banking crisis. And I'm very curious to know what your signs and signals are pointing to while everybody else is kind of panicking and not knowing what to do.
I view this banking crisis as a buying opportunity. I typically view volatility as an investor's friend, whereas a lot of the headlines would have you think otherwise. And I think there are clearly some problems. Some of them were created by the Fed, who kept raising rapidly. But it's not as if they didn't telegraph that. But now we have some rogue banks, and I would call Silicon Valley Bank a rogue bank because they had no risk controls. So we have some rogue banks that have basically gone belly up because they didn't listen to the Fed. And up until January, the Fed was one half of the equation in terms of what I was looking at. And clearly the Fed hiking rates was a negative for the market. But in mid-January, I basically did a pivot and turned bullish based on some very strong technical momentum indicators.
All right. Yeah, let's talk about that and refresh our listeners on the power gauge. That's really what I was sort of headed to with the question. Like, the power gauge is telling you that, told you in January that it was time to get bullish again?
It did, because so many stocks were going into uptrends, which turned the power gauge rating, which is a combination of 85% fundamentals and 15% technicals, bullish. And interestingly, the sectors and industry groups that started to turn bullish were really surprising. Semiconductors. And so if you sideline yourself because of this banking crisis or because you thought the bear market wasn't over, you've just missed a decade bull move in semiconductors since the October bottom in the stock market, which, by the way, has not yet been broken. So we got this signal on January 13th, put out a special bulletin on January 17th, and basically looking at advancing versus declining stocks on the New York Stock Exchange, there's a high watermark, which on a 10-day basis, when twice as many stocks have been up on average on the day versus down, that triggers what's known as a breakaway momentum signal. And this signal was developed in the 1970s by a very respected technician named Walter Deemer, who was at the Putnam Funds and then went on to start his own institutional brokerage firm, actually won the Market Technicians Lifetime Achievement Award, or I think it's now called the CTA Lifetime Achievement Award, for this body of work that he's assembled. And since 1950, so we're looking at 73 years, there were 18 signals prior to January. And in every one of those 18 instances, it marked the end of a bear market. And so based on that, with everybody sort of waiting for the Fed to pivot, waiting for the recession to be officially declared, waiting for earnings estimates to come down, we basically turned bullish. Now, the S&P 500 was at 39.99 at the time. It's roughly at 39.99 again, but an awful lot has happened since January 17th.
Well, yeah. I mean, and the move in, I noticed the move in semiconductors sometime after you did, and it was kind of breathtaking. I think AMD is up something like 50% year to date. Just they took off like rockets.
Indeed, even poor stodgy Intel is starting to break out.
That was the one that surprised me.
Well, here's another surprise: Micron Technology, which is more of a commodity memory chip type play, that's starting to look really good, both in the power gauge and technically. So I think, the key to have navigated this bear market started in January of 2022. And now the subsequent upturn to me has been to combine fundamentals with technicals. That's what we've always done. That's what we preach to our subscribers. And that has really worked, not just in semiconductors, because there are some other groups that we can talk about that have had spectacular moves since the October bottom in the S&P 500.
Right. And it's interesting to me that the power gauge is 85% fundamentals. We talked about this before, and you got a good signal in January.
We did because, well, first of all, we ranked 3,000 stocks on a relative basis. So we're never going to have 3,000 bearish looking stocks, even in a recession and an earnings implosion. But you still have to have some positive characteristics, whether it's high return on equity, positive earnings surprise, meaning that companies are reporting better than expected earnings, analysts raising their estimates, industry group strength. There's a whole series of fundamental factors that mirror what some of the smartest people on Wall Street look at every day. And that's really the key. We had an institutional brokerage firm, my partner Bob Rogan and I in Philadelphia in the late 80s into the early 90s. And we had clients with a whole variety of different styles and time horizons. So we had value investors in the Mid-Atlantic region where we had deep ties like Delaware Management, T. Rowe Price in Baltimore, with more of a growth-oriented manager. We had hedge funds in New York like George Soros and Steinhardt and Paul Tudor Jones. And we also had very, very smart growth investors in Boston who went on to big things, both Jeffrey Vinnick, who succeeded our friend at Fidelity, Peter Lynch, and other very strong investors. So what's common about that list of investors? Well, they all followed a discipline, but their discipline was different. Some looked at value factors like PE. So one of our clients who actually became an investor in Chaikin Analytics, Tony Hitchler, sadly passed away recently, did the seminal research in low PE investing. He built a firm called Brandywine Capital around that and sold it to Legg Mason. And so when you take these various investment styles and time horizons, some were shorter than others, there's some common factors that everybody looks at. And basically the power gauge is what I call an eclectic model, as opposed to a religious model. So Warren Buffett, in the purest sense, has a religious way to look at the market. He has a strict value discipline, except he owns Apple. So, before it was a value stock. Bill Miller at Legg Mason was a value investor, but he ended up owning Apple in a big way, which contributed to a couple of years of outperformance. The point being, if you synthesize all these factors, weight them separately, but take all of them into account, you end up with the power gauge rating. And it does a damn good job of identifying stocks that are likely to outperform and underperform the market over the next 3 to 6 months.
Right. So I want to talk about this idea of a rolling run-up. It's a prediction that you've made, and you're actually going to have a webinar about it on March the 28th. But what does that mean? What's the rolling run-up, Mark?
Well, let's go back to February of 2021, when we started identifying what we called a series of rolling crashes, starting with innovative technology. And, Kathy Wood's ARC Innovation Fund is sort of the poster child for what happened. These stocks peaked in February of 2021. Most of them had no earnings. And these were the darlings of the hot money momentum traders and investors crash. Fast forward another 3 months, different sectors started going into what I would call rolling corrections, or 20% down in the market. Now we're in a situation where, except for energy, which was in its own bull market in 2022, which was something the power gauge identified, you're starting to see stocks bottom out and go into uptrends. And that's what we call this rolling wave up. And so first we saw it in the building sector. The home building sector has had headlines that are just ugly until today, when home sales skyrocketed because prices are starting to come down and interest rates are dropping. Then you saw it in building materials. So while everybody's been talking about a recession, construction and engineering stocks have been through the roof. Another bull market started in October, November of 2022. Now you've got the semiconductor and software stocks going into a bull market based on the power gauge and based on the technical price action. So I expect that over time, we'll see all of the 21 industry groups that we follow, each of which has an ETF that you can trade based on a Standard & Poor's index, ease into a bull market. And I think if you're an investor, it's less important to put a label on what the market might be doing. And so I think one of the biggest mistakes that people make is to say, well, it's a bull market or it's a bear market. I prefer to look for opportunities and risks. So, for instance, 3 or 4 of the banks that have imploded in the last 2 weeks had power gauge go bearish in either April of 2022 or July. So Silicon Valley Bank, Silvercrest, all of these banks, First Republic, saw the power gauge go bearish. Now, at the same time, stocks like JP Morgan and Citi had bullish ratings. So something was clearly up. And we didn't know what it was, but the power gauge, if you follow it religiously, will keep you out of trouble and then find opportunities. So I'm seeing opportunities in the marketplace in a variety of industry groups that I think are in a rolling bull market phase.
Aha. So the power gauge is essentially saying the bear is over, it sounds like. But I understand you don't like to say bull or bear. So.
Well, on January 17th, we said the bear market is over. We're in a bull phase and buy the dips. And we continue to think buying the dips makes sense, even in the face of a banking crisis, which is very serious. But I think one thing I would say is that you have to have some discipline in the market so you don't put your feet in cement. I think that's the biggest mistake people make. They fall in love with stocks like a Tesla, don't give it up, or a Zoom during the stay-at-home bubble for these stocks, or they fall out of love with stocks. So interestingly, some names that the power gauge was bearish on in 2021, 2022 have now seen their ratings go bullish. And they're names I wouldn't have expected. DocuSign, for instance, really became front and center for investors who did any sort of legal type transactions during the COVID lockdowns. If you bought a house, if you entered into any kind of contract, DocuSign was on the email that you needed to fill out to finalize the transaction. DocuSign had a bullish rating for part of the upswing, and then the rating turned bearish. Now the rating has turned bullish again. Roku, a stock that I never particularly understood because streaming's not an easy business, especially when you're competing with Netflix and Disney and so forth. Power gauges turned bullish on Roku. PayPal, which has had a checkered recent past in terms of their public image, in terms of the fees that they've charged people that have attracted a lot of negative comments on Twitter. PayPal has a bullish rating. So these are not fly-by-night companies, but they're companies that have been beaten down by these rolling bear markets that started in February of 2021.
I see. Tell us what are you simply on the 28th, when you have your webinar on the 28th, what are you going to tell investors? Can you give us a little sort of I know you can't tell us the whole thing, but can you give us a little sort of a sneak peek preview of what we're going to see when we tune in on the 28th?
Well, we've got a bullish message overall, and we're going to focus in on this pattern we just described, the breakaway momentum pattern, but we're also going to be talking about the 4-year election cycle and what that means for stocks in 2023. And that was part of the reason that I was waiting for some sort of sign, from the heavens, or in this case, a technical signal, because in the pre-election year, you've made all your gains in the market. Typical pre-election year from the low in the midterm election year, which we just experienced, you see a rally of anywhere from 30 to 50%. So I was primed to be bullish. And if we are going to get a bottom in here and experience some of that upside. And obviously, the banking crisis has derailed the bullish train for the time being, which I expect they'll get back on track. If we are going to see that upside, there's a particular pattern that I identified over 30 years ago that we're going to talk about and give people access to, that enables options traders to find opportunities with potential 3, 4, 6, 9 months out. So we're going to be talking about a way to leverage the potential gains in a bull market using a very sort of well-refined strategy that I first discovered over 30 years ago. Well, it works because human emotions haven't changed, Dan, as you know. And the ebb and flow in the market is a very concrete expression of human emotions. I used to say that fundamentals drive the market, but emotions drive the market to extremes. And so what we want to do is take advantage of those emotional extremes, the little setbacks, if you will, that you see in every bull market. And you're experiencing one now in some of these industry groups and stocks that we talked about: construction and engineering, home builders. You had some pullbacks in semiconductor stocks. And it's that pullback after an uptrend has been established with a bullish power gauge rating that we're going to leverage for what we think are outsized gains.
Nice. So I have my co-host, Corey McLaughlin. Looks like he's chomping at the bit here. He's got his microphone up like he's got something on his mind. I feel like I should let him chime in.
There we go.
All right. Well, I just love listening to Mark explain anything about the market. So it's a treat just to sit here and listen to it. But I want to ask you about, you're also the person who I heard this first stat from was every bear market since 1955 has ended when the Fed or central bank lowers interest rates, right? Doesn't just pause them or stops hiking them, but cuts them. And I know you just said don't get lost in the definitions of a bull or a bear market. How do you weigh that with your kind of bullishness right now?
That's a really good question, Corey. And as I said, until January 17th, that was holding me back from really turning bullish. But even in spite, John Templeton, who said the 4 most dangerous words for investors are "this time it's different." Every cycle is different, and we're in a new world. And so it may be that we'll have identified a recession post facto, and we'll have identified a bear market bottom back in October when the Fed finally pauses. Historically, you're correct that has been a requirement or a precursor of a bear market bottom. But look at what just happened to put it into perspective and say, well, maybe it is different. We just had a run on the banks that was triggered by a wave of pessimism from Silicon Valley venture capitalists and their minions who have started all these companies that they've backed in 24 hours. Why did that take place? It took place because of Twitter. And because these messages were amplified from hedge fund guys like Bill Ackman to smart venture capitalists to the people that are influencers. And what used to play out over 6 months played out over 24 hours. And that's clearly different. I mean, we've never had a run on the bank because you couldn't. You had to get in line, take your money out. You can now transfer money, as you know, electronically. And it is different. We wouldn't have had, if these comments from the various Silicon Valley bankers hadn't been amplified the way they were, there might have been a time window for Goldman Sachs, who was working on it, to raise the equity capital that Silicon Valley needed. But they didn't have that time because it may just be a different environment. We all know the 24/7 news cycle as it pertains to political and cultural issues. But now we just witnessed that, that Twitter phenomena, the Facebook phenomena in the financial world. And so would I have liked to see the Fed pause and maybe lower rates before calling for a new bull market? Of course, but it just doesn't feel like it's going to happen that way this time.
I see. Does any part of your strategy or outlook or anything, like you care about the Fed and what they do and what they've done, but does any part of your strategy sort of depend on it directly? Do you make bets on, banks or interest rates or anything that might be directly related to Fed policy actions?
Well, the nice thing is the power gauge sort of factors that in by looking at analyst estimate revisions, analyst rating changes, a whole series of shorter term factors that can kick in almost overnight if the macroeconomic climate changes. So, yeah, I think inflation is obviously the big issue. If it wasn't for rampant inflation, the Fed wouldn't have raised rates that way in what's basically a historic arc from 0 to almost 5% in the Fed funds rate in less than a year. So the inflation numbers have been coming down. So here's an interesting point. If you're trying to game the market, which is virtually impossible, you had the January inflation numbers come out and there was a hiccup. At least we think now there was a hiccup. So after 6 months, peaking in June through December, of year-over-year improvement in the inflation rate, still admittedly very high, January number came in, announced in early February, as an uptick. Well, what did the market do? It just panicked. Then the February numbers came in last week in the middle of the banking crisis, and they were dropping again. So it's really hard to look at the fiscal and monetary factors and be an intelligent investor. I couldn't do it. As I like to say, when one of my colleagues asked me a loaded question about this or that, I say that's above my pay grade. That's why I created the power gauge, because left to my own devices, there's something called recency bias and confirmation bias, and I'm sure you've had people on who've talked about it. So let's just look at confirmation bias. You're bearish on the market and you turn on CNBC and you get a reinforcement. It's like a booster shot to your bearishness. Yeah. If you're bullish on the market, you can find a commentator who supports your position. It's impossible to look at the headlines, read the analyses, try and parse the reports that come out every week, the economic reports, and be a successful investor, in my view.
Right. So I eventually get to this point with a lot of folks like yourself where you're macro aware. You can't not be aware of these things, but your system is really, it's kind of bottom up, isn't it? I mean, it's bottom up on 3,000 companies, but it's a bottom up way of looking at things. It's a highly disciplined way of looking at things that doesn't let all that noise influence you too much. But as you said, your system kind of bakes that in. This is a common theme. Like we talk to bottom-up investors all the time who actually do use a combination of fundamental factors and some momentum factors. And they always wind up in sort of just about the same place as you do. You're highly disciplined. You're aware that you're a human being. You can't ignore these other things, but the system takes care of it for you.
Well, with one major caveat, we are top-down driven. We look at sectors, we look at industry groups.
Well, yeah.
And, for me, the ideal situation is a stock in a strong industry group with a bullish power gauge rating that's under accumulation. And I've been finding these stocks for over 40 years, not with the power gauge since 2011. So that's 12 years. But I worked at a brokerage firm called Shearson Hamel in the mid-'60s. They had an incredible research department. And I was in the main office, so I got to know the analysts. Well, their research was great, but you needed technicals to overlay. And I started to see patterns with earnings estimate revisions. Back then, you had mobile home stocks. We still have Skyline, by the way, which is a fabulous performer right now. But we had 3 or 4 mobile home stocks: Fleetwood, Champion Home Builders, Skyline, Winnebago fell into that category, oddly. And what I noticed was, if analysts were bullish on one company and raising their estimates, suddenly they were bullish on all 4, not always at the same time. So I discovered early on in my career as a stockbroker They now call themselves investment advisors or registered investment advisors. We were stockbrokers. That there was, a herding effect in the stock market. So I wouldn't characterize ourselves as bottom-up investors. I think we're top-down. We just don't. I don't go beyond, and even rarely go into the market level. I mean, in theory, should start with a market view, sector, industry group, the best stocks within that industry group. Some of the really successful investors like George Soros or Stan Druckenmiller, who are clients of mine, would start with a macro view. Ray Dalio at Bridgewater, starts with a macro view. That is really above my pay grade. And the power gauge does solve that problem because ultimately a macro view filters down to what analysts are doing and saying about individual stocks and industry groups. But you don't have to you don't have to be in the weeds on that data as long as you're monitoring what the smart money is doing and saying. And 5 of the factors in our model, what we call the expert opinion factors, look at smart money. We look at short sellers. We look at analyst estimate revisions. We look at analyst rating changes. We look at industry group relative strength, and we look at insiders. So those people have a macro view, and we monitor what they're doing. And that's how the macro gets incorporated into the power gauge. I don't have to be, a genius with an MBA and, 20 years of experience analyzing the Fed. It gets filtered in through those 5 factors.
I see. Great.
You seem skeptical, Dan, but I'm going to...
No. Believe me, but most of what you do is above my pay grade. So, I'm just wanting to understand it because I'm actually a huge fan of the power gauge. I mean, how can you not be? It's sort of a money-making machine. And I want to talk a little bit more about what we're going to see on March the 28th. But I do want to tell people that they can go to ChaikinEvent23.com, ChaiKin event23.com, and you can sign up for this event on March 28th. So sounds like we're going to hear about your bullish view. Are we going to hear about, like, you're talking about sectors a moment ago, and that's, your top-down view begins with sectors. So are we going to hear about, all the best sectors that you really like at this very moment?
We're not going to get that granular. We are going to have a couple of surprise guests that I think everybody will respond very positively to. We're more into what we see coming in the market and how to take advantage of it. And by coming in the market, I mean how to sort of capitalize on these rolling bull waves as they sweep through different industry groups. And so, not unlike what you do every day, we're looking at the market through a lens. And that lens is the power gauge. And the power gauge not only ranks individual stocks, but it ranks sector and industry ETFs. And that's probably more important to our process than anything, because if you find a stock with a bullish power gauge rating, that's one thing. But if you find an sector and an industry group within that sector that have bullish ratings, and that would be technology right now and software and semiconductors on the industry group level, and then look for the best of the best in those industry groups and wait for this one particular pattern to trigger, you've really got a trifecta of tailwinds. And that's what we're going to talk about, how you get a tailwind in your investing and translate that into outsized returns. Now, along the way, we're going to obviously let some information drop, and I don't want to be too specific about it. We're also going to talk about the Fed and what they're doing. And this is sort of the culmination, Dan. In November 15th, we did an event. And the theme of that event was that there are changes going on in the macro picture that's going to cause a run on the banks. We didn't know how it would surface, but it was obvious that with short-term rates approaching 4% back then, and banks offering almost nothing to their depositors, something had to break, and it did. And so this is really the companion to that. In that event on November 15th, we talked about what's unfolding now. Didn't know how it was going to unfold, which companies would be identified as Warren Buffett likes to say, swimming without any clothes on. This is now the other side. I think we're coming through the other side of all this stuff that was very important, still is, fighting inflation. It's critical. And so this event is about how you capitalize on what we think is going to be a very positive last half of 2023.
Positive last half of 2023. Some of the macro guys are saying recession last half of 2023, economic downturn last half of 2023. It's the exact opposite view. I was just listening to a podcast with Lacey Hunt on it, a very famous economist and bond asset manager focused on bonds. And he was sounding very dire about the second half of this year and saying that he was expecting a downturn.
Well, I spoke at a conference with Lacey about 4 years ago in San Diego, that's sponsored by John Malden, and Lacey was bearish then. So I wouldn't call him a perma bear, but he's a perma scaredy cat about, he's looking at velocity of money and lots of other stuff. He was a client of ours because he came out of Philadelphia, out of that whole value sort of group in Philadelphia, Provident National Bank, and all the asset managers that spun out of that. I respect Lacey's work, but people have been talking about how the national debt is going to kill us in the end. And I'll go back to what one of the things that John Maynard Keynes said: in the end, we're all dead.
Yeah,
and
in the long run.
If you're constantly scared, and I'm not saying that there aren't problems, and I'm not saying there's not going to be a recession. We're probably in a recession right now, except it's the oddest bifurcated recession you've ever seen, with job growth off the charts. But if you're an investor, you've got to be looking for opportunities. And it's a really trite saying, but there's a bull market somewhere. Mm-hmm. Interestingly, leading up to the turning bullish in January, the European markets were blasting ahead of the U.S. markets. So there's opportunities everywhere. And, as I said to someone who was preaching the bearish case yesterday, I said, if you really believe that, you should sell every stock you own, pull your money out of the banks, put it under the mattress, and buy some puts. But that's not a long-term prescription for growing your retirement.
Absolutely not. There's an upward bias in the market because there's an upward bias in humanity, right? We all get up every day trying to do our best and innovate and grow businesses and do things. And
I'm into
it's
that.
Always, yeah. So I always, as bearish as I ever am, which I have been a lot in the past year and a half, I do always come back to that. And I feel like systems like yours, it's just a way of acknowledging that and always looking for the opportunity, always looking for that, that next bull market. Obviously does a pretty good job of it.
And by the way, Dan, you were absolutely spot on to be bearish a year and a half ago. And that has played out very nicely for your subscribers. But the power gauge is sort of a reality check. So whatever your fundamental rationale for investing is, whether it's quantitatively based, whether it's analysts at Morgan Stanley or UBS, whether it's Jim Cramer on TV, the power gauge is a reality check. And you're bearish on a stock and the power gauge is bullish, under accumulation, you're just fighting a losing battle, in my view. On the other hand, if you're bearish on a stock and the power gauge is bearish or neutral and the stock is underperforming the market, that's where you're going to get your biggest bang for the buck. And those are the stocks you absolutely have to avoid. And, we've got one that we're going to talk about if people sign up that is a big surprise, I think, particularly since we've seen real strength in the mega cap stocks. So if people sign up, they'll go to our microsite for the event, and they'll see two stocks with very surprisingly different power gauge ratings.
Wow. Okay. I mean, I'll be there. I'm looking for it. I'll write the tickers down just along with everybody else. All right. So we've been at this a while here, Mark, and we've come to our final question. Same question for every guest. Every guest gets the same question, no matter what the topic, even if it's non-financial. And that question is, if you could leave our listener with a single thought today, besides going to ChaikinEvent23.com and signing up, what would it be?
It would be that investing is a means to an end. And it's a way to lead a better life, to share that with your children, grandchildren, with charities, if that's your inclination. And it's not the be all and end all. It's a means to an end. And I really think people need to be balanced about it, unemotional and rational in what they do.
Amen. Amen. And thank you for that. Well, thanks for being here, Mark. Really looking forward to the event on the 28th. Can't wait to write those tickers down. And, just thanks again for coming to talk with us. And I hope we'll do it again soon.
Dan, Corey, always a pleasure. Thank you.
Many mainstream analysts are predicting that stocks will recover soon. But I say we'll instead witness a cash frenzy unlike we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation or any of these other things. As all this unfolds, the financial consequences of what I'm talking about could last for several decades if you don't understand what's happening. There will be winners and losers, and now is the time to decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone for a free copy of this new report. I love talking with Mark. I've known him for, a year and some now. And, who would fail to be impressed with Marc Chaikin, for God's sake? The guy has had, Soros and all these other people for clients, and he's been around forever. And he's got tools that are on every Bloomberg terminal in the world. It's just, he's a fantastic guy and a fantastic investment mind. And I hope that you'll go to ChaikinEvent23.com and sign up for the event. I'm sure Corey will be there.
I will be watching too. That was a great interview, and it reminded me of the first time I spoke with Mark and heard his story and all the different investors that he worked with and watched, and then came up with his tools and blended fundamentals and technicals. It was like right up my alley. So it was. If anybody hasn't checked out his stuff, I think you should, honestly. And the power gauge, I've gotten lost in there for, an hour or two, and I didn't even really want to be doing that. But there's so much in there. And like he said, it looks at 3,000 stocks, and, it's very easy to follow. And I'm sure he'll talk more all about that during his event. But yeah, it was good to hear him again.
Yeah, if you're into market timing, power gauge is the thing for you. And it continues to fascinate me to no end that it's 85% fundamentals. I just think that's incredible. And it speaks to what I feel about how the market really is supposed to work. The market is supposed to be about the fundamentals of the businesses and industries within it. It's not supposed to be this sort of gambling casino with stocks swooning and soaring and people trying to guess which way the next, wind is going to blow. I guess Power Gauge does that, but it does it based on something that just makes a lot more sense to me, and it obviously works great. So I guess I'll just say one more time, to sign up for Mark's webinar on March 28th, go to chaikinevent23.com, CHAIKIN event23.com, and sign up, get Mark's wisdom, write down some tickers, maybe sign up for Mark's service, and I'm pretty sure you're going to be a happy camper pretty soon. So that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_hour. If you have a guest you want us to interview, drop us a note at feedback@investorhour.com or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.